All right, we're going to get started. Hi, everyone. Thank you for spending your Wednesday evening with us. We have a jam packed hour, so I won't take too long for the introduction. My name is Mark. I'm the co founder and CEO of Sarwa. And Sarwa, we actually started in the DIFC, and we have another entity in the ADGM they offer different services. But today isn't about Sarwa, it's an educational seminar because one of our mission is to make money work. But in parallel to that is to educate people on sound investing. Just a personal story before I hand it over to our amazing speakers. When I studied finance in McGill in Montreal, I would solve quite a few problems around portfolio construction and a lot of theory where you had equities, bonds, and a lot of things. But when it came to one common thing when we would construct a portfolio was the risk-free rate would be around 3%, 4%, 5%. So you would have something called a risk-free rate where you could assume that it's risk-free because you're lending to the US government. And this was a good part to have in your portfolio as part of diversification. But when I graduated and started working in finance, and any one of us where there aren't that many gray hair, working in finance or investing in the last 15 years, we lived a zero or near zero interest rate environment. So that has a specific implications that we're bringing in a speaker that specializes in fixed income that can help us zoom out, look at fixed income, and try to make sense of it within gold, within the US dollar, and some common themes we're hearing about today. But it's really key. What we like to do at Sarwa is to zoom out beyond 15 years so that you're not stuck getting an echo chamber of a short-term mindset when you're investing for decades and not necessarily a couple of years. So with that, I'll hand it over to Ayman and Dino, and really excited about it.
Thank you, Mark. Oh, I forgot that I'm mic'd up. Watch. Okay. Good evening, everyone. How's everybody doing? Audio levels are okay? Excellent. My name is Ayman Gebre. I'm the head of wealth advisory here at Sarwa. Today, we have a very unique and special seminar talking about all things macro, micro, US dollar, gold, interest rates, very relevant and topical items that people are talking about today. It's going to be a conversation where we hope that you'll have some insight, some context, and also just to keep you abreast of the conversations that are happening around the world. I am joined by a special guest. And before I introduce him, I want to give a little bit of context. We do work with selective partners around the world to drive and champion our initiatives to empower and democratize investing. Franklin Templeton is one of those partners. Franklin Templeton, just to give you a little brief background, is one of the world's largest asset managers. They have over $1.4 trillion in assets under management that span all the way from equities to fixed income to money market to many other different assets that are available for investors. The individual that we have today is Mr. Mohideen Kronfol, or very affectionately termed Dino within the halls of the DIFC, who's come to join us today to share his insights, and he's an extended family member of Sarwa. So please, everybody, please welcome Dino.
Thank you very much for that very kind introduction, Ayman.
Well, I may add, by the way, so Dino actually is the Chief Investment Officer and also the Portfolio Manager for the Global Sukuk Fund, and also for the MENA Fixed Income Fund that he manages himself and his team. So without further ado, shall we jump into it, Dino?
All ears. Yep.
Absolutely. So let's start with the niceties at the very beginning. It's important that the conversations that we're having today should not be interpreted as one-on-one financial advice. This is a conversation that we're having to provide insights, to have a bit of context, but each and every one of us have unique circumstances. Just as much as we all have different names, we also have unique circumstances, and the way that you approach your financial planning should be bespoke and unique to you. So do speak to a financial advisor. And secondly, we do not have a crystal ball. So any questions regarding what's going to happen tomorrow in the market or the day after or a few weeks from now, at best, it would be an educated guess, but the underlining is it's a guess. Nobody can predict the future. Okay? Let's have our conversation, and maybe I'll get a little bit cozier and come closer to you, Dino. All right, perfect. And I'm sitting on my mic. Excellent. So Very topical item altogether today. And thank you, Mark, for that great introduction. We were talking about fixed income. Um, Now, to give a little bit of background, asset allocation is probably one of the most important variables when it comes to good investing. And when we say asset allocation, a well-constructed portfolio will typically have assets that range from equities, fixed income, maybe different sectors, geographic coverages. This is essential to good planning altogether. Now, with regards to fixed income, I wanted to ask you, what role does fixed income play when it comes to good good asset allocation?
I mean, it's huge because the two principal objectives or aims of fixed income are to provide income to your portfolios over time. So going back to Mark's earlier story, whatever that risk-free rate is or whatever the coupons are, I mean, that's very important to be able to generate income for your portfolio. But then the other very important dimension is the protection, because when we have recessions or when we have difficult market environments, that's typically a period where interest rates come down, and that usually causes bond prices to go up. So if you have a well balanced portfolio, in theory, as your equities are facing difficult times, your bond portfolio is actually doing quite well, and then the reverse is true. So what it does is it really smoothens out and makes your portfolio a little bit more resilient, a little bit more stable, pumping out money, and then giving you the appropriate level of risk that you're comfortable with. So fixed income certainly plays a very important role, and I think today it's particularly poised to play a more significant role going forward.
Absolutely. I think we're going to be covering that in a bit as well too. So it's no wonder that regardless of where you go, whether it's a bank overseas, wealth management firm in different parts of the world, fixed income tends to be a key or core component of all advice, really, at the end of the day.
Yeah, I mean, I think the rule of thumb is 60-40, right? I mean, obviously it's a function of people's risk tolerance, but your basic starting point usually is 40% in fixed income, 60% in equity, and then you start making changes depending on what, the personal circumstances are, what your outlook is, and then a variety of other factors which I'm sure your advisors can give a little bit more color, but certainly it's a key pillar of any thoughtful portfolio.
Absolutely. So you touched on interest rates, you talked about volatility, you talked about safety. I think it's a good time to also look at just a little bit of a recap of what the last few years have been for investors from from an experience perspective, right? And be- there we go. And I'm going to stand up for this one because I can't see backwards as yet. So I'm going to recap a little bit from 2019 to 2023. Up until the COVID period of 2020, we had a generous period of time in the markets. The S&P 500, and I want somebody to fact check this for me, please, so feel free to Google it, had gone up by 400% from 2008 until 2020. So it was a period of time, a lot of prosperity. The markets have been quite generous and a very low interest rate environment, or relatively low to where we are today. But we got a little bit of a shock to the system in 2020. WHO declared COVID 19 a global pandemic, and all fear set in and panic. And then we started seeing sell orders. We started seeing the market drop drastically to the point that circa 30% is what the S&P 500 had dropped down by. In response, we had the Fed drop rates imminently at that point in time because they need to spur economic activity. Everybody was at home, factories were shut, nobody was going to work, there was no production whatsoever. So, in response to try to encourage economic activity, they dropped interest rates, which is typically what the Fed normally does. We enjoyed that for a brief period of time, as in a very low interest rate environment. And if anybody remembers during that period of time, we had nowhere to go. We had nowhere to spend our money. And all the stimulus programs that were happening all around the world were starting to accumulate in savings balances in individuals' accounts. And there was nowhere for it to be channeled to. You couldn't go out, you couldn't travel, you weren't necessarily buying a house, you weren't necessarily, buying a big screen TV. Some of that money channeled its way into the capital markets themselves, and we see a very steep rise in the S&P 500. As time went by, we started seeing the COVID lockdowns basically starting to diminish. We're starting to see some flexibility. People were able to leave their homes, starting to travel, and there was quite a bit of pent up demand. Unfortunately, this pent up demand was not met with supply of goods because, as I said earlier, factories were basically shut. People were working from home. It takes a while for factories to start the production to get back to that scalability that they were before. So you had an imbalance between demand and supply. And what that did was start causing inflation. Goods that you wanted to purchase cost you a little bit more. There was a lot more competition for that same good, and also cost production a little bit more to get back up and running again. But the market kind of chugged along, did quite well, but inflation started kind of rearing its ugly head and started getting a little bit worse and worse. And to kind of add insult to injury, we had the announcement of the Russian-Ukraine war, which just added more pressure to inflation because whole wheat, gas were commodities that were under pressure. There are major suppliers of wheat and gas to the world. And at that point in time, the Fed started acting. And they started acting by raising interest rates. At first, about, I think it was 50 basis points, and we saw 50 basis points. And at certain later points, we saw 25 basis points because they needed to find a way to quell inflation. And that brings us to where we are today, where we have inflation rounding off about 4.9%. The overnight Fed rate, you're looking at between 5 and 5.25%. And the S&P 500, still well ahead of where we were back in July of 2019. We're sitting at 4,124. So this is just a little bit of a recap. Now, this brings us to today. Where do we stand on global events or global state of events today, Dino? As far as, maybe a little bit of a recap, maybe your perspective on what you saw there, and also what are we experiencing at this point in time?
Yeah, I mean, I think the last 3 years, the COVID situation clearly had an enormous impact on policy. And I think a lot of what we've been dealing with is in many cases, a result of the response to the pandemic. In the early phases, a lot of the driver of inflation was really supply bottlenecks, transportation costs, all of these sort of product related issues. And then you're right. I mean, the Fed did cut rates, but we can't forget that actually it was fiscal policy that really also drove inflation. So we went from goods inflation into services inflation, which we're still navigating. And I think it's very interesting because a lot of what we're dealing with today is very much a result of the policies that were adopted over the past 3 years. And the world today is very different. I think also something worth highlighting is that period where you started seeing stock markets go down also coincided with a period where bond markets also were going down. And that's a little bit unusual because remember how we were saying earlier, usually when you have a balanced portfolio, when one is going up, the other is going down. So 2022 was an interesting period because both markets, in fact, went down. And that's why a lot of people had a lot of losses last year. But it was genuinely an unusual year in that respect. And I think as we look forward, we have to be careful not to just assume that what happened in the past year is going to be the same thing that's going to happen going forward, because historically the relationships, do diverge. And to your point, now you're in an environment where rates are above the rate of inflation. So we are probably at the end of this rate hiking cycle, or what we call a peak. And that has important implications for how to invest going forward. We'll speak maybe about those different periods in the cycle.
I remember distinctly that point of time, you're right, where equities and bonds dropped quite significantly, which is unusual.
Nowhere to hide except cash, yeah.
And we tried, we have conversations quite regularly with clients and try to kind of paint the picture, but there was a period of time where literally every asset class was impacted because there was a sense of panic and fear in the market itself.
Yeah.
Excellent. Well, what I would say, what are you paying close attention to today with regards to any metrics, and I know you've sent some details over, so feel free if you maybe want to take the clicker.
I mean,
if you'd like.
these are so from our perspective, obviously inflation is very important. I mean, that's clearly the stated objective of the Federal Reserve today, is to bring inflation under control. These rate hikes have been, obviously very rapid. It's important to keep go back to our textbooks when we were in school. Ultimately, money supply is probably the most important determinant of future inflation. And that money supply, which is the green line here, you can see how precipitous the decline is. And as that comes down, so too we think will inflation and inflation expectations. So that's very important because that's a key driver of Fed policy. So if that comes under control, we can have a little bit more confidence that the Fed will not be raising rates much more from here if they're not already done. Right? And knowing where you are in this cycle has important implications for what to do. Because just for everyone's benefit, I mean, the cycle, there's 4 cycles that you're going to be in at any point in time. Either we're going to be in a period where the Fed is hiking rates, which is the phase we've just been in or we're ending. The next phase is being at the peak, and that has important. And then it's usually followed by a period where the Fed is cutting rates, and then there's a trough. And knowing where you are in one of these 4 phases has important implications for how different asset classes perform. The good news is last year, when the Fed was in a hiking cycle, that's typically the worst phase for fixed income. The next phase, peak, and then a cutting cycle, those 2 are actually quite positive for fixed income.
Okay.
They're a little bit more of a mixed bag for equities, but we can talk about that a little later.
Absolutely.
So that's an important, I think, graph or chart to keep in mind.
If I may, just if we can elaborate as far as the impact on fixed income and interest rates, for example. So you mentioned there's different impact to fixed income depending if interest rates on the upward trend or going down. Maybe we can elaborate a little bit more on that.
Yeah, I mean, in a hiking cycle, interest rates are going up, right? So that typically impacts bond prices negatively. So the total return you're going to get on a fixed income portfolio may be negative. So in that instance, typically it's more favorable for equities, maybe cash. At the peak of a cycle, usually it's good for duration. Interest rates, especially longer term rates, start coming down on expectations that we're done with the hiking and the next phase is going to be cutting. So usually that's quite conducive for duration or for interest rates. It's not so good, or it's a mixed bag for equities and for risk assets. So spreads or the extra return governments and corporates have to pay above the risk-free rate, that typically rises when you're at the peak of a cycle. And it rises even more when you're in a cutting cycle, because in the cutting cycle, that's usually a difficult macro environment. So equities don't do well, spreads typically don't do well either, and commodities for certain don't do well, because that's a period where economies are contracting. Right. So we are now, in my mind, I'm increasingly confident that we are at the end of this hiking cycle. We're probably at the peak. So I'm pretty confident about fixed income going forward. I think for spreads and equity markets, it's going to be neutral to maybe slightly negative for the coming 6 to 9 months, depending when you think the Fed will actually start cutting. But once the Fed starts cutting, there's a real risk to spreads and equities. And obviously, your advisors can recommend what the best course of action to do, but that's where you want to be careful about your risk assets.
Yeah. No, definitely. We're going to be covering that in a bit, anyways. So I think.
How do I?
Oh, you just got to press it quite firmly, quite meaningfully.
Yeah.
There you go. So we've done the inflation bit. Here's where we're talking about employment.
So most of the indicators in the US are pointing to significant slowdowns ahead. If you look at financial market metrics, things like the inverted yield curve, things like leading indicators, a lot of things are pointing towards a coming recession. There's a debate over how hard of a landing that recession, or how deep of a recession that would be. The one bright spot has actually been the labor market, and that's been the main argument that the Fed has used, and other market participants are looking at as a signal that the economy is very strong. The Fed may need to keep raising rates, but even there, we're beginning to see signs that things have peaked, and labor markets typically are backward-looking or lagging indicators. So as we're trying to think about the future, we don't want to get too fixated on just this metric. But it is true that wages and the job market in the U.S. has been quite healthy. But if you look at the combination, I think as we go forward, you'll see that moderate as well. And I think the other important reality or fact is that a lot of people have been talking about how inflation's kind of out of control, the Fed's trying to bring it under control, etc. There's a lot of narrative around the Fed having lost a lot of credibility, and they haven't done a very good job managing the last couple of years. But the reality is the market has been or the market's view of inflation has been very stable, has been very grounded. I mean, throughout it all, these are two measures of the market's view of inflation, and you can see that it's been between over the last 2 years between 1.5 and 3.5. So that's even when inflation rates were at 8 and 9%. The market understood that these were temporary, and that the Federal Reserve's actions of raising rates were going to bring that under control. So we're not in an environment where the Fed has lost control or lost the narrative, and so there's no reason in my mind to feel like people should have no confidence in markets. The markets are functioning, they're working well. The Fed has taken the appropriate steps. It's taking some time to feed through, but we're getting to that stage, I think, where we're at the end of that cycle, and now we need to prepare for the peak of the cycle.
I think it's just a matter of people don't like it. Nobody wants to pay higher rates, right?
So that's the reality, and these things happen with a lag. So the impact of all of these rate hikes, we're going to start feeling them now. Some of our mortgages, reset in a year or two. If you want to take out a new loan, it's much more expensive, and you already see oil prices are $40 off their highs. You see Saudi Arabia cutting production. So there's a lot of signs that are showing that what's happening in international markets is migrating to our markets. And we should be feeling that economic growth is going to slow down as we go forward.
Okay.
The good news, on the previous slide is
this one here.
No, this one.
Yeah.
Is that we have one on yields.
There
this
we go.
One. The good news is that because of the Fed's hiking of rates, the yields, or what you can earn on your fixed income, is at the highest level it's been in 20 years. And more than anything, that is probably the single most important determinant of forward returns. So people that invest at the peak of those cycles, if you look at, for example, the dark green line, or you look at the light green line, those are the yields on offer for fixed income benchmarks. And the other lines show 12 returns 12-month later, 12-month forward. And you can see how highly correlated they are to those peaks. So if you look at that yellow line, you have to be thinking, where do you think that's going to head over the next 12 months? And we're increasingly confident that the returns, that investors are going to generate, having invested in the past 2-3 months, are going to be in that high single-digit returns. So when yields are high, 12-month forward returns typically are also very high. So this is actually, in our mind, a very good time to be increasing allocations to fixed income.
Okay, thank you for that. What I'm going to do is I'm just going to skip a few slides because the interest of time, because we've got so many topics that we've got to cover. Maybe a brief insight about UAE. I mean, we're talking about things being at a high. We're talking about market activity. Maybe just brief insight about what are we experiencing here?
Yeah, the UAE and the GCC has really, they've done a great job.
Yeah.
I mean, coming out of the last oil price collapse, you had a number of measures that were put in place to address the last fall in oil prices. So you had a lot of fiscal consolidation, a lot of structural reform. So we went out, we started removing spending, removing subsidies, we started introducing taxations, we started changing a lot of social and political rules and regulations, trying to make the markets more attractive to residents, to investors. And not just in the UAE, obviously Saudi Arabia has had a tremendous amount of reform, political, social, and economic. And that's coincided, obviously, with a very good public health response to COVID. I mean, if you can all, we've all had a pretty good experience, I think, relative to our friends and people we know outside. And then the reopening was also very successful.
Yeah.
But now, and so all of that has is evident in the numbers, in the performance numbers, in our growth numbers. Rating agencies, for example, have upgraded Qatar, have upgraded Saudi Arabia, last week upgraded Oman. So a lot of good news has really come through, and we all feel it. We've really had a good reopening. The challenge, I think, is that we may be at the peak of all of this great performance because the rate hikes, are going to feed through. We have pegged currencies. As the Fed raises, their interest rates, the central bank in the UAE also raises rates. Deposit rates are going up. The cost of lending is coming up. Money is getting harder to have. Valuations are more challenging. So it's going to be a more difficult environment for people that need to borrow money, for sure. Then you have oil prices. They've come off the highs, and they could be a little bit more to go if the US actually has a stronger recession. So you think about it on balance, and also oil production has come down. So when you were running budget surpluses the last couple of years, you're going to be flat to slightly negative. So our performance has probably peaked for the time being, and we're going to be in a more neutral environment. But on a relative basis, I think we're very well placed compared to, say, the more developed markets or the US or some of the other emerging markets, because we're entering this period from a position of strength. We've been accumulating reserves, we have money, they've been doing well, the banks are in good shape, companies are in good shape. So there's not that much to worry about. But the overall global environment is becoming a little bit more challenging, and that's going to migrate to our markets.
I mean, and we feel it, to be honest with you, day to day.
Okay.
When you go to the malls, when you're trying to get onto the road, trying to book a ticket out or trying to bring family in, all the pillars of the major industries in the UAE are benefiting. It's almost like a perfect storm, really, at the end of the day.
Yeah, but so that's interesting because I feel anecdotally that it's still very busy. I mean,
That's what I'm referring to, is what I mean.
So yeah, it's all good. I'm expecting that to slow down a little bit now,
Maybe-
but so far it hasn't. You're
Right.
right.
No,
I mean,
100%.
things are really operating. I mean, you look at schools, you look at cars, you look at hotel occupancy, you look at real estate prices. All of these are looking very strong.
Yeah, I think we feel the real estate prices more than
sure.
here seeing altogether. This brings us actually right on point to interest rates itself. Some would look at the do you want to sit? Some would look at interest rates as of course, there's negative side effects to it. So borrowing costs increase. Maybe big ticket items that you were considering financing in the past, you're likely to hold off and put them, at a later point. But some also look at the opportunities with high interest rates as well. More specifically, the banking industry, for example, the financials, they tend to do really well in this time period. Individuals who have deposit balances in the savings account, they tend to do a little bit better, right? So it's a mixed bag, but was curious to see, for example, from a equities perspective, fixed income perspective, or maybe any other asset classes, which I think you touched on earlier. What's the impact of interest rates on these assets?
So we go back to these 4 stages of the cycle. If you can go to the next slide, I think.
Yes.
Yeah. So in a hiking cycle, usually 10-year rates you see go up. That's the result of higher rates. That's negative for bonds. So a hiking cycle, which is what we've just been going through, is the worst thing for fixed income markets. It's typically good for equities and risk assets. So you see spreads or the cost of funding contract. Typically equities do well and commodities do well. That's in a hiking cycle. But we're coming to the end of that. We are now entering the peak phase or peak cycle. And that's usually good for debt. It's not so bad, but it's not great for spreads. But on the balance, it's still good for fixed income. For equity, it's a little bit of a mixed bag, and it's generally negative for commodities. And that's, I think, the phase that we're kind of coming into. And then there's obviously the cutting phase that comes after, which you'll be hearing a lot about that. When is the Fed going to cut? Market expectations are that may be towards September, maybe December. There's going to be a big debate over when the Fed does that. You said something great, which was none of us have a crystal ball. We don't know. But it's probably, in the coming, 6 to 9 months, 12 months max, we're going to be in a cutting cycle. So these are important. If you go on the next slide, you can look at the different scenarios, the different examples. So these are all the periods when we were at the peak, and you can see what's happened in each one of those episodes. If, broadly speaking, in all of those cases, 10-year rates So long bonds have, generally speaking, done well, anywhere from 60 to 175 basis points. Spreads rise, not very much. Not they rise, but that's not too bad. And no, it doesn't take away the overall impact from duration. So overall fixed income tends to do well. Equities, some periods it does well, some periods it does poorly. And then commodities, generally speaking, are kind of flat to negative. And that's, I think, the period we're going to be in now for the next 6 to 9 months. So that's important to keep in mind. And as you look forward, because I'm sure everyone's thinking longer term, you get into a cutting cycle. And if you don't mind going to the next slide, that's what's probably in store. Once the Fed starts cutting rates, they start cutting rates pretty aggressively. So it could be that they cut 100, 125. It could be they cut all the way back to 2%. No one knows. It would depend on how big of a recession, how big of an impact these rate hikes have had. But in general, it's a period where risk-free rates or bonds do very well. And it's usually a period where equities and risk assets don't do very well. And that's probably the phase where you want to be in higher quality, you want to be defensive, you want to be very thoughtful that whatever you're putting your money to work in, they can manage a period, difficult operating environments, difficult financial conditions, a period where it's not easy to raise money. That's what you want to be conscious of. So usually bigger companies, high quality, just kind of, issuers that can manage a difficult period, and that's kind of what I would keep in the back of my mind.
Thank you for that, Dino. So this isn't our first rodeo, though.
Right.
You've been in the industry now 25 years, right? You've practically built the MENA fixed income scene here altogether. So you probably have been through a few of these, right? I want to kind of highlight this chart here, which I love. I love looking at this thing because it really puts things into perspective, really. History at a glance, right? We have gone through many rate hikes. We've gone through cutting cycles. We've gone through recessions. We've gone through wars. We've gone through significant political events all throughout the world. But there's a commonality that we see altogether. And that commonality is that markets generally trend upwards. And I think that's a very powerful visual for me, at least, because it puts things into perspective and it definitely helps me sleep well at night when it comes to looking at my investments. We look at Great Depression, we look at World War II, Vietnam War, the oil crisis, Chernobyl, Gulf War, for any of those who've been here in the region itself, in a very harrowing point in time, 9/11, again, COVID period altogether, but it shows you the power of had you invested $1,000, and of course, I'm not expecting anybody to be here from 1925, but it just serves to show you the picture that over time, that markets generally reward you for being patient and for being disciplined. And then additionally, there's an additional reward for diversifying your portfolio, which we're going to get into in a very short period of time. Anything you'd like to add on this one, Dino?
No, I think you make a great point. I think, starting saving, being diversified, there's no substitute for that.
Absolutely.
And being aware of the big picture and where you are on the cycle, I think is also very important.
Thank you. Let's talk a little bit more about US dollar.
Oh.
The elephant in the room, is that what it is? There we go. The US dollar. So, it's a topical, conversation right now where people are saying, hey, the US dollar, is there anything I should be worried about? How does it all work? What's happening, etc. But, there is fundamental reasons as to why the US dollar rises in value and depreciates in value. So wanted to get your perspective. Why does the US dollar vary in currency value?
I mean, there's several reasons why you have demand for a currency. You could use it because it's a good store of value. You could use it to trade. You could use it for investments. So, what its real rate of return is probably one of the most important determinants. But then there's also the relative strength, because nothing you look at is in isolation. You have to, whatever you think of the US dollar at any point in time, you have to make a view or have a view about how it compares to the other currencies. So that's what makes currencies, I think, a little bit more challenging than other asset classes for average people to invest in. It's actually very difficult for professional investors to do well calling. I mean, one of the hardest things to do is to trade FX over short periods of time. But if you look at it again over a longer term basis, things like what the real rate is, what your interest rates are, and how you are, what the growth rates are for the US, whether they're running current account surpluses or deficits, that all has an impact. In the case of the US, and the case for the dollar isn't looking great right now because we're thinking that, yes, rates have gone up, but they've arguably peaked and they may be declining over the coming year. So that's important. When you look forward, there's a lot of good news priced in.
Mhm.
They're also running budget deficits, fairly large ones, and they obviously have a very large, current account and trade deficit with the rest of the world, from China to Europe to the rest of the world. So those on their own typically would be enough to say that the dollar should be declining as we go
Mhm.
forward. And normally, that's what we would all expect. The only challenge is, or the only problem is that the dollar in particular, it has a special place as the reserve currency of the world. And on a relative basis, it does well compared to other currencies. Having said that, I am of the view that the dollar could weaken over the coming 5, 10 years. I mean, the next decade, I think, should be weaker for the dollar, but more because of interest rates coming down and other markets doing well, not necessarily because I think the dollar is going to lose its place as a reserve currency, or that there is necessarily going to be another currency that's much better than the dollar. It's just that we're at that stage of the cycle. There's a lot of good news. The dollar's rallied a lot the last 10 years. We could have a more normal relationship with other currencies as we go forward.
No, that's spot on. It's funny because even the next slide itself kind of highlights what you were talking about,
Ah,
interest rates specifically as well. For anybody who was in a position to have borrowing in the 80s, especially if you were in the US or North America for that matter, it was normal to have double digit interest rates on mortgages and personal loans and cars, car loans and whatnot. So it's not surprising that the US dollar had appreciated in value quite a bit during that period of time. And we saw, of course, as interest rates started to go down, we saw the dollar also reduce in value as well. And things pick back up again in the 2000s. And you'll see that it's quite normal behavior, that the dollar will fluctuate relative to other currencies within a certain band. So it's quite normal behavior of the dollar itself. And you mentioned 10 years, it has been, on a very strong run. And if you compare it to other major currencies all around the world, whether it's the Chinese yuan or the euro, Australian dollar, or Russian ruble, I mean, maybe a bad example, Russian ruble, Canadian dollar, Japanese yen, you've seen a gain
yeah.
altogether.
Significant gains. I mean, this looks like you have a good 15 to 20% gain over the past decade. So seeing that correct, 10%, 10, 15% would
Quite
be
normal.
consistent, yeah, with history.
But what does it mean then if your investments are denominated in dollar, right? We're talking, let's say, we're going in a cutting cycle now, and eventually we should see the U.S. currency being devalued a little bit more. What does that mean for investments that are ETFs, mutual funds, any instruments for that matter that are U.S. denominated?
I think the currency of a particular investment is just another layer that you have to consider. And you know, if you think, I mean, if you have a strong held view or you believe in that and you want to diversify further, it does make the case to invest in, non-dollar assets.
Mhm.
You could invest in Japanese, equities. You can invest in European equities if the valuations are right, and you could get a currency gain. That could be supportive. But as always, when you introduce currencies, you have to be extra careful because they do add risk to your investment. Because you could have a situation where the stock is doing well, but the currency isn't. So getting that right is tricky, but I do think is an important consideration. And yeah, I mean, having some investments outside of the dollar in general is like a good diversifier from my perspective. But how much really is a function of your risk tolerance and whether or not you need these other currencies. You know what I mean? If you're planning to retire in Europe, it's not a bad idea to have some euros. On the other hand, if all your liabilities are in dollars, maybe you don't take. But at the end of the day, most people are going to have a substantial portion of their assets in the US dollar.
Absolutely.
That's not going to change too much.
And especially considering that we're in a region that's pegged to the dollar itself, there's certain benefits to it, there's certain ease and flexibility. Most financial instruments, I would probably say, are offered in dollars themselves, at least the ones that are, I would say, very cost effective.
It's by far the most liquid market. It's by far the biggest market. It's the main reserve currency. There's a lot of media, social media, talking about the demise of the dollar, and I would just be very careful about those projections. There's not a lot of, in any one of those, they never offer an alternative. They tell you the dollar is terrible. Okay, but what else are you going to do?
What are the alternatives?
That's where I feel like those arguments really lose a lot of credibility.
And taking it even further, so it's like, okay, well, what is the next step? If it's not going to be the dollar, what does that look like?
Yeah.
What is the most trusted currency as we speak today? It's the dollar.
Probably the euro. But that has its own challenges, obviously, with the Ukraine war on its doorsteps. The Swiss franc, but it's a small economy. How much can you own? And there's an argument to be made about the strength of the Chinese economy, but again, their currency is not free floating. It's not easy to convert. Doesn't have the same convertibility. So we'll have to see if the Chinese currency can, over time, be a counterweight to the dollar. But as it stands today, it's certainly not the case.
Yeah, fair enough. Thank you. An effective strategy, and we touched on this earlier, and you mentioned diversification about multiple currencies. Take, for example, in our Sarwa portfolios, Sarwa Invest, you're normally offered a portfolio that's based on US markets, emerging markets, developed markets. And depending which type of portfolio that you have, either you'll have some exposure to REITs, to commodities, through gold. You may also have exposure to Sukuk as well. The importance of that is looking at your investment picture on a global scale. Not only do you have exposure to different countries, but you also have access to different sectors within each and every one of these countries themselves. And a really great way to be able to tap into these markets is through the use of ETFs. An ETF, for example, there's one here that we utilize in our portfolios is IEFA. It's a developed market ETF, and it gives you exposure to financials, industrials, healthcare, consumer staples, information technology. And this particular ETF, it gives you exposure to different countries such as Japan, UK, France, Switzerland, Germany, Australia. And it continues. And as you'll see that this is a common theme at Sarwa about diversification, looking to de-risk your portfolio, protect you from the downside, and increase your opportunities for the upside. Even, for example, when you look at our Franklin Global Sukuk Fund, which I think maybe I'll send it over to you to be able to talk about it a little bit more.
Yeah, to your point, we try to diversify. We try to diversify our book as well as much as possible. And an important source of that diversification is just looking at different countries. So, as any actively managed strategy, we're going to be looking at opportunities wherever they are. And in our case, we're scouring the globe to look at any Sukuk opportunity. If it meets our investment criteria, is liquid, there's some price discovery, we think there's some value, we'll consider it. But you can see also a very large portion of our Sukuk fund is actually invested in the GCC in our region, which enjoys very high credit ratings, relatively modest levels of inflation, good growth numbers. We were just saying a lot of financial strength. So we're feeling pretty confident that this, with all the uncertainties that are out there, we're going to be relatively well placed.
Amazing. Thank you for that, Dino. We're getting towards the end of the presentation here now, and the last core subject is commodities, gold. Very popular. It's often referred to quite often in our conversations. How do you view gold from an investment perspective, Dino?
So I'm generally a fan of gold. I don't think that's a very widely held view. People would argue that it doesn't serve a very good purpose. It's a relic. But I'm not one to stand in the face of 3,000 years of human civilization. People get comfort in gold. They resort to it during times of uncertainty and stress. It's always served as a store of value. And when we're entering a period now where inflation is a little bit more entrenched, the dollar may be peaking, We have these geopolitical events already in Russia and Europe. There is a risk, I suppose, of it happening maybe, with China and Taiwan, and there's other, potential geopolitical flashpoints. It's always a decent hedge. And then, we also come from a region where we've had a lot of conflicts, whether in Lebanon or Syria or Iraq. And you ask anyone, they having a little bit of gold, when times were tough,
Yeah.
served a decent purpose. I think I would be very careful how to invest in gold.
Hmm.
There's, I'm sure there's a variety of different ways. So just be careful how you approach it. And I would, in my mind, I would use it as a hedge. But is there a place for gold in a portfolio? I think yes. And I don't look at gold just as another commodity. I think it is. It does serve also as a counterweight to currencies. So I think there's a bit of a dual function, and there's a place for it in portfolios.
Amazing. I'm going to go to our last question, Dino.
Oh,
And something that we ask a lot of our guests is young Dino, 18 years old. You have the opportunity to have a
so long ago.
conversation with the young Dino. What sage investment advice would you give to your younger self?
Um, Things like start early would be start investing early, start saving early would probably be the single most important advice. I think the risk is always when you're young and you're not making that much money, you tend to feel like, well, what's the point of saving? If I do all of this and I end up with $5,000 at the end of the year, like what, why bother? Let me just go enjoy it and, take a trip.
Hmm.
But, as your work and your persistence pays off, and then when you actually come into money, I think having started earlier, having found good advisors, good banks, good financial institutions, having started a saving plan would allow you to then save properly and invest properly when you actually do make money. And I think when you don't do it, what often happens is you finally make some money and you don't know where to begin. And then you often do investments that are, a little bit rash, maybe too risky.
Hmm.
And you end up, squandering, these hard earned savings.
Hmm.
So my advice to myself would be to start early and to really spend a little bit of time thinking about who you want to work with, how you want to invest, like which institution or which broker, which financial advisor, and be patient with it. Start early, go, you're going to need it. And so yeah, that would probably be the biggest thing, is just start early and pick a good company or a good financial advisor, and kind of educate yourself and get into the habit of saving early. There's no substitute for that.
Absolutely. No, I couldn't agree more, honestly, Dino. I mean, I have conversations quite regularly with individuals who, unfortunately, for whatever circumstances, started a little bit too late. And there's a fair bit of catching up.
Yeah.
And at times, I guess the eagerness to catch up pushes them into making,
Big
taking,
mistakes.
yeah, exactly.
Yeah, and I would be I'm guilty of that. Having started a bit late, having taken that, I can always do it later, and also being in the industry where you always feel like there's another good trade you can do tomorrow. Yeah, I didn't start off at the right time, and I'm kind of, we pay the price later.
It's
So definitely, I would encourage people to start saving early, even if it's not a very large amount.
amazing.
And
Thank you.
actually, your institutions are a perfect segue because you're not a high cost provider of very valuable advice. And so that actually works out very well, particularly for those savers that don't have maybe a very large amount of money. It's
Absolutely.
perfect.
Our whole goal was always to democratize investing,
Yeah.
utilize technology, to bring down the operational costs, pass the savings on to clients themselves, remove the barriers to entry. And that's the idea behind it through Sarwa itself.
Which is why it's such a pleasure to be here and support that effort.
Thank you very much, Dino. Sincere pleasure, guys.
Thank you.
We do have 5 minutes, and we have a very strict cutoff at 7 o'clock today because we're actually after hours reserved the spot here. So we do have 5 minutes. So if anybody has any questions that they'd like to ask, feel free. Happy to have a chat. Yes, sir. Oh, where's the mic actually?
So that's a great question. The question is, why are central banks in the world accumulating their gold reserves? I think one, it's certainly maybe a function of their investments. Gold has done well. They probably see where you are on the cycle. It could just be an investment decision. As they manage their reserves. But I think when it comes to central banks, I think the geopolitical risks are certainly present and top of mind. The example of Russia, once it got into the conflict with Ukraine, not being able to access its reserves serves as a very strong lesson to many places that they need to diversify, their reserves. And so they're going to try to find alternatives to the dollar. It's not an easy task, but where they can, you can see them increasing their allocations to gold. So I think it's a dual component. There's reserve management, there's a view on gold, but there's certainly a geopolitical dimension. So, the more uncertainty you have, that's supportive. But when there is interest to be earned on money, that usually weighs against gold slightly. Um, so where it balances out, it's a little tricky. Um, and gold will be volatile. That's why I think you have to be careful how much you have. And if rates do come down, that could be supportive for gold prices because the opportunity cost actually comes down a little bit.
Okay. I think that's the cue there. Maybe one last question, if I may. Yes.
If we end up in a, let's say, stagflationary environment, how do you see equities and fixed income play out in that environment? And do you recommend, second question to that is, the 60-40 according to your chart didn't work out in the last decade. Do you think 60-40 in the next decade will be a good strategy, or would you suggest a different mix?
So, I mean, the last few years hasn't been great, and the stagflationary environment is bad for both. But I don't think that's where we're headed. It does feel like money supply is coming down very quickly, and inflation is going to be at much more sustainable levels. Where we settle, I don't know if it's 2 or 3, but it certainly feels like it's going to be. It will continue to come down, and it'll be below where interest rates are. And as far as growth is concerned, yeah, I think it's going to come off, but it's going to come off as a result of policy. So once you start feeling like once we hit that recession, the Fed can always then cut rates, kind of re-stimulate the economy. So in conclusion, I don't think we're in a stagflationary environment. I think we're at the peak of the cycle, and as we navigate that, it's going to be good for fixed income. It's going to be okay for equities short term, but I think as you hit that recession, if it's a strong one, equities could be vulnerable. So I would be more defensive now. So in fixed income, I'd be long. On equities, I'd be cautious. You'd have to have some, but I would be in more defensive sectors, in more value, for example, versus growth.
There was a second point you mentioned with regards to the 60-40, right? And what I'll do is I'll just want to highlight something on the chart itself. So at the very top of the chart, you'll see the green line. It's talking about US stocks. And this is explicitly stating just 100% equity exposure in the US market. But there's a secondary line that says growth portfolio. And typically, most growth portfolios are 80-20, 80% equities, 20% fixed income. And there's a third line that says balanced portfolio. So you're looking at your 60-40, right? Why I'm showing this to you is because the journey itself is just as important as the outcome. For example, every individual has different risk appetites. Some may be very comfortable with volatility, meanwhile, some may not. And those who decide not to take a more equity focused approach to investing understand implicitly that maybe the returns may not be as great. However, the journey might be much more, I would say, comfortable. If you look at the volatility that the US stocks have had and you compare that to a balanced portfolio, you'll notice that there are slight differences, right? Now, if you have the stomach, if you have the tenacity, if you have the comfort level of being patient and willing to think long term, there are benefits to taking a more aggressive approach over the long term. However, if you do feel that you may, react emotionally and find yourself exiting from the market, kind of sitting on the sidelines for a bit, and maybe a balanced portfolio might be ideal for you. The idea is longevity, and in a journey that allows to meet within your capacity of I would say volatility and fluctuation, and that's within your tolerance level. I would much rather you stay invested for 30 years in a balanced portfolio versus being invested in a growth portfolio and being invested for 5. It's all about longevity. It's all about ensuring you get the best return possible.
And you know your income requirements are going to be very important to answer that question. If you need income throughout this journey, then that will determine how much fixed income you have.
Thank you, everyone. Really appreciate it. This will be recorded, so if anybody is looking to review this afterwards, you'll receive it in your emails. Thank you very much. Have a wonderful night, everyone.